Funding a trust is an essential step in estate planning. A trust is a legal arrangement that allows a person to transfer their assets to a trustee who manages the assets on behalf of the beneficiaries. Trusts can be used for a variety of purposes, including avoiding probate, reducing estate taxes, and protecting assets from creditors. However, a trust is only effective if it is properly funded. There are two main methods of funding a trust: conventional methods and an alternate method using electronic asset schedules. Conventional methods involve specifically drafted transfer documents that are signed in front of a notary public. These documents are used to transfer realty interests, non-qualified equity accounts, business interests, contractual interests, and accounts payable to a trust. The alternate method of funding a trust involves using asset ledger schedules, in particular, electronic asset schedules. This method is provided by the ITS MLCP funding kit. The asset ledger schedules are used to list all of the assets that will be transferred to the trust. The schedules include information such as the name of the asset, the value of the asset, and the location of the asset. The schedules are then attached to the trust agreement and become part of the legal document. Regardless of the method used, it is important to ensure that all assets are properly transferred to the trust. This includes real estate, bank accounts, investment accounts, business interests, and any other assets that the grantor wishes to transfer. Failure to properly fund a trust can result in the assets being subject to probate, which can be time-consuming and expensive. One of the benefits of funding a trust is that it can help to avoid probate. Probate is the legal process of administering a person's estate after they die. It involves proving the validity of the will, identifying and valuing the assets, paying any debts and taxes, and distributing the remaining assets to the beneficiaries. Probate can be a lengthy and expensive process, and it is often best avoided if possible. By transferring assets to a trust, the assets are no longer part of the probate estate and can be distributed to the beneficiaries without going through probate. Another benefit of funding a trust is that it can help to reduce estate taxes. Estate taxes are taxes that are imposed on the transfer of assets from a deceased person to their beneficiaries. The federal estate tax applies to estates that exceed a certain threshold, which is currently $11.7 million. By transferring assets to a trust, the assets are removed from the grantor's estate and are no longer subject to estate taxes. In conclusion, funding a trust is an important step in estate planning. It can help to avoid probate, reduce estate taxes, and protect assets from creditors. There are two main methods of funding a trust: conventional methods and an alternate method using electronic asset schedules. Regardless of the method used, it is important to ensure that all assets are properly transferred to the trust. Failure to properly fund a trust can result in the assets being subject to probate,